Okay, hey, I just wanted to show you something real quick. Um, like when I said back in I think back over Christmas break, yeah, whenever we were in North Carolina, that the market would snap back just as fast as it, went down. Oversold, too far oversold becomes extremely overbought, and this is all signs of a bad market conditions overall. So this, I mean, it has went nothing but straight back up after going straight down. So there's a reason why it went down in the first place. And so I want to show you like in the past when that's also happened and like what's occurred as a result of that. Let me. Uh, okay, so um, this is the current market. Well, actually, this is it from a few days ago. But what you can see is, it went all this way down, and then it snapped right back up like nothing ever happened, right? Well, something did happen. This right here is not normal market activity. This over here is normal market activity because where is it falling down to? It's falling down back down to this uptrend line, falling back down to this uptrend line. This right here is not normal market activity. Okay, so right here I made this chart. In this chart, it goes, if you can look right here at the bottom and see this is 1990, 1992, 1993, all the way through all of these years. And I went and I've labeled and shown what's happened as a result of a few different things. So the number one thing you can see here is there is this trend line connecting all of these bottoms right here, right? It connects these all the way up. Right here, a trend line connecting all of these. Right here, a trend line connecting all of these. Okay? In each case, it was eventually broken, broken, broken. Okay. Whenever it broke here, where did it go back up to? It came down first, touched the red, bounced up to the blue. Okay. This one wasn't the exact same, but it did end up going down to the red, coming back up to the blue. Look where we currently are now. Fell to the red, right back up to the blue. Okay. And but that was after the trend line break. So basically, it fell over 25% to the red line, which is the 200-day EMA, and then bounced back up to the blue line before the bear market began in 2000, in the year 2000, before the dot-com bubble or the dot-com crash, and then back in 2008, 2007, leading to 2009 collapse, right? So in each of those cases, you had an amazing opportunity on this bounce back right here to get out of the market and allow it to do its thing to the downside, and presumably allow it to do its thing to the downside. What do you see here also that occurred? So the negative divergence, and this was followed by the PPO entering this bearish territory. So anything below this zero line. So there's basically a zero line in the middle. So if it's above here, the market's going up. You see how right here the market's going up? Up. It's bullish. It's bullish this entire time right here. This entire time it is bullish. When does the market become bearish? It becomes bearish whenever this is down here, right? It becomes bearish whenever this is down here. Up here it's bullish. Are there like sometimes a little bitty quick snapbacks that go up on it for just a second and then come back over? Yes. But whenever it's an uptrend, primarily bullish. It's on the top side. It's above this zero line. In bear market, it's below it. So it comes down here, curls like it's about to start going back up, and it rolls over. Comes down here and curls like it's going to start going back up, rolls over. Comes down here and curls like it's about to start going back up, rolls over. I mean, that's the assumption here that I'm making, that the next step will be the rollover. See right here, this is normal market activity right here. This is very bullish. This is okay in this instance right here. This and so even in this case right here, though, if you do notice that once it went back up, it ended up completely retracing all of this move. But we're in a much different position right now, technically, than we were at that point as well. So I do believe it's going to fail to go back across the zero line, as it did here, as it did here, as it did here. the difference between here in this case and these other two cases whenever it was a bear market is that this retracement back down was followed by more downside, which is what I believe will happen this time. We're going to see it come up and start rolling down. And so my expectations are, so number one, we'll look at like the Fibonacci retracements from this 2000 high down to the very bottom of the 2008 lows. And you can look up the Fibonacci retracements and see how important they are and all that type of thing in the real world. And you'll see that they're super important. And look how well it predicted this. So bottom to the top, 100% to 0%. So where did the 261.8% level come in at? 290.40.79. The top of the market was 290.40.91. I mean, that's almost too perfect, right? Almost too perfect. And you can always see like where these levels are. There's significant resistance, like right here. Boom, comes up, hits a 78.6 and or hits a 68.1 first. Look, boom, hits it perfectly, falls off of it, right? Comes up here, hits a 76.8, falls off of it, right? Here you see where the resistance is at the 161.8. It goes up. The thing was, the market never came back down and like retested this area. Okay, and so you're about to see something in this next image. So remember this 2072. Okay, that was from this Fibonacci retracement. Okay, so if you do the same retracement right here, from the very top of this to the very bottom, it shows the 61.8% retracement to be 2072.112. In this case, it was 2072.19 for a completely different retracement. So I would arguably say that this is a very important level, that I do believe the market will come back down to. And so this right here shows that basically if you buy one contract of ES for $6,600, a short to my first target here, which is the 61.8% retracement, which is right here at this level, would end up returning you $31,400. So basically, what is that? 6 times 5. Basically you make 500% on your initial investment. And so my second target is a 38.2 retracement. I'm not saying it's going to get that low. I'm going to take profit here regardless, but I do think there is a possibility that it could come down here to at least this level. And so if it were to do that, the profit would be $57,500 from the initial investment. But like I said, I will likely be taking profit right here because the way that this is going to set up on the chart, it's probably going to be very good for a reversal. At least if it were to come down here, boom, it's going to bounce back to this area probably before going back down again. So number one, these are the values that I found important, and so then I also went and looked up a lot of other people's research and seen what they think is about to occur. Like, do they think this is the end of the bull market? I mean, you can see the end of the bull market here came after the trend line break, after the bounce off the red, after the bounce off the red, after the bounce off the red. So what do they think? Like, what stage do they think we're in right here? What's different about this bounce off the red and this one right here? Okay, and so this guy right here, he's very good. He's called CCM Market Models, and they like they model all of the market, like going all the way back until like the early like 1900s. And so what he does here is number one, a comparison. It just shows this is what December 7th, 2001 looks like, and this is what February the 8th, 2019 looks like. All well and fine. You have this V drop off that bounces back significantly. And then so from here, everybody's saying, okay, yeah, the market's well and fine. It bounced back. That was the end of the correction. Yada yada yada. A couple months later, you're in this stage, and it's basically we're about at this step right here, I would say right now. And then additional 34% loss came after this time. So what are the odds that the market goes back down to at least retest this low. Okay, well, actually, I'm sorry, this low. In our case, in the 2019 case, what is the odds that that's going to happen? And so they went back and did this. And so they looked at 21 similar historical cases, the days and the percent decline to new low retracement low. Okay, and so it shows that the average case was so like right now the market's actually up to I think like 27,400. So this was a few days ago whenever I got these images. So the market's basically right here right now at this perfect resistance. But so they said that the average case is that it's going to fall to 22,000. I'm sorry, 2,244, and the median case is 2,332, which in both cases is lower than this previous low. And they also put the days to retest the low, and they also put the odds of it occurring, and the odds of a new low, retracement low occurring is 95%. And then a significant retracement has an 80% chance. So, I mean, it's very likely that we will go down here, but beyond. And so then they went farther to even actually show all of these numbers on a graph so that you can more easily see what they believe is very likely. Okay, so they show all the cases in which we've had a bear market, and theoretically how far the market would go down from this current position. You know, to show exactly like where it would be at. So hypothetical S&P 500 drawdowns based on actual historical drawdowns. So there are 4 cases that show it going down to here. So what level does this actually end up being? That actually ends up being that 2072 level that I found to be extremely important earlier. That 2072 level would result in a return of 500%, given that you short it up here. And also given that you get some of the funds out of the market, because there's, I mean, 4 cases of it just going down to here on past historical drawdowns. But as you see, there are more cases in which it went much farther down. So this is the 1987 case, which would put it here, which, you know, was that, that was, what level did I have for that? That was, did I have a level for that? Yeah, that ended up being that 1800 retracement. I mean, perfectly on that retracement, actually. Yeah, dead on it. So, I mean, so that would be the 1987 case if the same thing were to happen in 2019 or 2020. In 1973, this is the 1973 case, which would be, what is that, 15? It's about 15, probably 25. What was my other? Yeah, 1535. I mean, so number one, they're showing the past historical cases in which the drawdowns were a certain amount. But I mean, I'm just showing you the fib levels in which I know to be important, and those so happen to line up, and it's not chance. I mean, this is all very real things. So in one case here, the 1973 retracement, there's a 2000. I mean, look how far the 2000 went down to. I don't expect to see like the 50% or something like that, but I do think a very significant retracement, such as here, is extremely likely, if not inevitable, and that would be that 500% return on investment. So here's the 2009 case, and then here's the 1937 case. So yeah, I think it's something that should certainly consider. I mean, we've had this huge bull market, and what you can't tell right here from this image is how steep these declines are. This doesn't look like a big deal in comparison to this right here, in comparison to this, but that's because this chart right here is not log scaling. This is basically a different type of scaling in which you can't tell how big, like these are just based on the number values from like 700, 1200 is going to be the same as 500 points up here. It'll look the same size, even though in percent terms, there's much bigger percent terms. Okay. See if I can exit all this. So if I pull up, So if I pull up, this is crude oil. Doing good on my crude oil trades today. Up 440 there. Forward slash. I'm doing good on the ES trade as well. Let's see here. So this shows you the chart as it is today, and yes, so we're up to 27,500. So let's put that on the daily. Okay, and see in this case right here, so this was not a very significant, this was not a very bad bear market. This wasn't even considered a bear market. This is overall, this has been the uptrend here. Let me show you where this is. So this is see, these are your bad bear markets here. What you're seeing right here in this image, it's just 2015. It's nothing bad whatsoever. But I'll point something out to you in just one second. Okay, so back here in the 2015 case, market fell, consolidated for a bit, bounced back up here to bounce back up these trend lines, and then fell. So what you need in most cases in order for there to be a lasting bottom is divergence. See, like right here, this sparked a rally. This divergence did. This right here sparked a rally. This divergence did. The divergence is, with this lower low here. Okay. In this case right here that we just had, there was no divergence. These lows right here very rarely stay, and that's how the CCM model was able to go back and look at its data, and it was showing that, in cases in which you don't have that divergent low, which means you don't have consolidation down here, for the market to do this and then bounce straight back up a few days later, there was no justifiable reason. Like these are huge moves. If you had caught this move from here, from 2,600 to 2,300 with just one contract, that would be equal to $10,000. So you'd made basically almost a 200% in a matter of 1, 2, 3, 4, 5 days. You'd have made that much money. And then almost the same way to the upside. See how fast this happened? This is not normal, healthy market behavior. But you see where it is now at these trend lines, and my assumption and many others is that this will mark the beginning of the end. So here in this case, it was end up being the beginning of just another pullback here in the ongoing bull market. But in this case here, it should be a pullback, or this should be the snapback rally in a bear market. Okay, so this is the first move back. So when you're talking about the powerfulness of moves in a bear market, you have the first move down, which looks like this. The first move down here like this, and then so most of the time your most powerful snapback rally is the second, but that's generally followed by a much larger third wave down. This third wave down would typically be about this size, the size of this right here. Duplicate. It'd be the size of this plus a half. And that's another reason why, it'll be the size of this plus half of that again. And so I don't have a way right now just to do exactly half of that, but just looking at it by eye, maybe about right there. And so what also does that line up with? It lines back up that $1,800 again. And so that is the expectation. If you come back over here and you look at the 2008 case, what happened? The market fell down a lot. And right here, this is a more lasting bottom actually at the time with this divergence that occurred. Sorry. Snap back up to the 200-day MA, which is back where the market is now. See how the market fell and it bounced back up these lines here. Okay, so we're in the same position back in 2008, in which it would have been amazing to get out of the market and to short the market. Boom, here, bounces back up, hits those lines. And so here's your A wave. Here's your B wave back up. And then here's the more significant C wave down. So like obviously this C wave was far more extended. So basically it would line up about right here, that 1.5, which is where I'm sure a lot of people end up buying. Again, they're thinking, okay, maybe this is a good position to buy. Turned out not to be, right? But I am saying that in our case that we have now, I do expect us to, at the very minimum, get this move down here, you know, and that would be that $30,000 that you can make with 6. So just want to show that. I guess we could just look at the 2000 case on my chart right here again. You know, you see the move down. Look what happened. Here's your A wave. Here's the B wave. Back up. Gets rejected at the trend lines right where we are now. And then what happened on the C wave? A much farther, more extended C wave down. And, you know, that eventually ended up leading to something like this. And yeah, if you were to I mean, and this right here isn't exactly scientific. I'm not trying to say that. It's nothing like the fib numbers, but it can at least give you an idea of how far these moves are and should be. And you can kind of see that one's pretty close to that 1.5 size for the C wave down. You know, that ended up being the bottom of the 2002 move. And so the whole point is there's no sense and being caught on the downside of one of these moves, especially knowing what I know now, what I'm able to show you. So just keep that in mind. And yeah, that is all.